A family dies, leaving behind $16 million. By the letter of the law, the federal government is owed 40% of everything above the exemption. On paper, that family should owe close to $1 million in estate tax. In practice, many families in exactly this position pay an effective rate closer to 3%, not through fraud, not through an offshore account in some tropical tax haven, through a set of legal tools so specific, so quietly written into the tax code, that most accountants who serve ordinary households have never even set one up. Here's a number that should genuinely bother you. Over half of the 100 wealthiest families in America have set up a specific kind of trust, one so effective at avoiding estate tax that the IRS itself has publicly called it a loophole and tried more than once to shut it down. It's still legal today. And as of January 1st, 2026, the rules just got even more generous. Under the One Big Beautiful Bill Act, the federal estate and gift tax exemption jumped to $15 million per person, $30 million for a married couple. And for the first time, it's permanent. No sunset, no expiration date pressuring families to rush. Meanwhile, the average American family is still filing a W-2, taking the standard deduction, and paying tax on every dollar they earn the moment they earn it. Two completely different tax systems, operating in the same country, under the same laws, one written in plain language for wages, and one written in dense legal architecture for inherited wealth. In this video, we're decoding the second one, the exemption wall that just got permanently higher, the trust that lets you gift a fortune to your children at a legal value of zero, and the structures built specifically to make sure a family's wealth never has to touch the estate tax again. Not this generation, not the next, not for 100 years. This isn't a story about breaking the law. It's a story about who the law was actually written for. Welcome to the Wealth Compass. This is the hidden tax code for the 1%. Let's start with the wall itself, the estate tax exemption, because almost nobody outside estate planning fully understands what changed in 2026. Before this year, families were planning around a countdown clock. The exemption was set to be cut roughly in half at the end of 2025 under prior law, and a state attorney spent years telling wealthy clients to rush major gifts before that deadline hit. The One Big Beautiful Bill Act changed that entirely. Starting January 1st, 2026, the combined federal estate, gift, and generation skipping tax exemption is set permanently at $15 million per individual, $30 million for a married couple, and it now adjusts upward with inflation every year going forward. No sunset provision, no expiration, just a permanently higher wall protecting a permanently larger share of inherited wealth. Here's what that actually means in dollars. A married couple can transfer $30 million to their children, completely free of federal estate or gift tax, before the 40% rate even begins to apply. For the overwhelming majority of American families, this number is so large it's almost abstract. The median household in the U.S. has a net worth far below $1 million, let alone 15. For those families, an estate tax conversation is functionally meaningless. There's nothing to shelter. But for families sitting above that threshold, business owners, real estate holders, multi-generational wealth, this single number determines how much of a lifetime's work actually survives to reach the next generation versus how much gets redirected to the federal government. And here's the part almost no one explains clearly. The $15 million exemption isn't even the main event. It's just the wall. The real strategy happens in how families get assets past that wall before they're ever counted against it. That's where the real architecture begins. Here's the tool the IRS itself has called one of the most effective estate tax loopholes in the entire code, the Grant to Retain Annuity Trust, or GRAT. The mechanics sound technical, but the outcome is almost absurdly simple once you see it. A wealthy individual, usually a business owner or startup founder holding stock they expect to appreciate significantly, transfers that stock into an irrevocable trust. In exchange, they receive an annuity, fixed payments back from the trust every year for a set number of years, until the original value of what they put in has essentially been returned to them. Here's the trick. The trust is deliberately structured so the present value of those annuity payments equals the exact amount contributed. On paper, mathematically, the gift to their children is worth $0. The IRS treats it as a zero-value gift, meaning it doesn't even use up any of that $15 million exemption. But here's what actually happens in the real world. If that stock appreciates significantly during the trust term, say, a startup founder shares triple in value after an IPO, all of that growth above the IRS's assumed rate of return passes directly to their children, completely free of gift or estate tax. The grantor gets their original contribution back. The appreciation, sometimes tens of millions of dollars of it, passes to the next generation as if it never existed for tax purposes. According to research into IRS records, more than half of America's 100 wealthiest individuals have established at least one GRAT. Some run what's called a rolling GRAT strategy, continuously creating new ones every few years, indefinitely, turning a single technique into an ongoing wealth transfer machine. It's not a secret. It's not hidden in some offshore filing. It's sitting in plain sight in the U.S. tax code. Most people have simply never been told it exists. A GRAT moves wealth to your children. But the wealthiest families in America aren't just planning for their children. They're planning for great-great-grandchildren who haven't been born yet. The tool for that is called a Dynasty trust, an irrevocable trust structure to hold assets for multiple generations, sometimes designed to last as long as state law legally allows, which in several states now means forever. The specific tax mechanism that makes this possible is the generation-skipping transfer tax exemption, the same $15 million figure as a standard state tax exemption, but applied specifically to wealth that skips a generation, passing from grandparent directly to grandchild, or into a trust that benefits multiple generations at once. Without this exemption, that kind of multi-generational transfer would trigger estate tax twice, once when it would have passed to the children, and again when it eventually passed to grandchildren. The generation-skipping exemption prevents that double taxation entirely, as long as the transfer stays under the threshold. Once assets are inside a properly structured Dynasty trust, something remarkable happens. They can stay there, growing for generations, without ever being counted as part of any individual family member's taxable estate again. Not the grandchildren's, not the great-grandchildren's. Families like the Rockefellers, the Mellons, and the DuPont built structures like this decades ago, and the assets inside them have compounded for nearly a century, largely outside the reach of the estate tax that touches everyone else's wealth once per generation. This is a fundamental difference between how wealth behaves for most families versus dynastic ones. For most people, wealth gets taxed, spent down, and rebuilt every single generation. For a family with a Dynasty trust, the tax event essentially happens once, and then the compounding runs uninterrupted for 100 years or more. That's not an investment strategy. That's a structural advantage no amount of saving alone can replicate. GRATs and Dynasty trusts get most of the attention, but the actual toolkit goes deeper, and each piece does something specific. Take the minority ownership discount. If an estate owns, say, a 40% stake in a family business, the tax code allows that stake to be valued below its true proportional worth, because a minority stake, on paper, is harder to sell and carries less control. Estates routinely use this discount to legally reduce the taxable value of business interests by 20 to 30% or more, even when the underlying business itself is thriving. Then there's the Spousal Lifetime Access Trust, or SLAT, a trust one spouse creates for the benefit of the other, moving assets out of the taxable estate, while the couple technically still has indirect access to funds through the beneficiary spouse. An intentionally defective grantor trust, or IDGD, deliberately structured so the grantor keeps paying income tax on the trust's earnings personally. That might sound like a disadvantage, but it's actually the strategy. Every tax dollar the grantor pays personally is effectively one more tax-free gift, to the trust's beneficiaries, on top of whatever assets were already transferred. None of these tools work in isolation. A sophisticated estate plan layers several of them together: a GRAT to move appreciating stock, an IGT to shift additional value through absorbed income tax, a Dynasty trust as the final long-term container, and a $15 million exemption as the baseline protection underneath all of it. It's worth being honest about the other side of this. GRATs specifically have been targeted by lawmakers for years. Proposals have repeatedly tried to eliminate zeroed-out GRATs and impose minimum terms and minimum taxable gift values. None have passed yet, but every major tax bill reopens a possibility that this particular loophole eventually closes. For now, though, the tools remain fully legal and fully available to anyone who can afford the legal fees to set them up properly. So what's the actual takeaway here? If you're not sitting on a $15 million estate, 3 lessons. Lesson 1. The tax code isn't a single system. It's dozens of smaller systems. And which one applies to you depends entirely on the shape your wealth takes. Wage income gets taxed immediately and directly. Appreciating assets held inside the right structure can grow for decades with the tax bill deferred, minimized, or in some cases essentially erased. The lesson isn't the rich cheat. It's that how you hold wealth matters as much as how much you have. Lesson 2. These tools scale down more than people assume. You don't need $15 million to benefit from trust-based planning, basic strategies, even simple irrevocable trusts, proper beneficiary structuring, and annual gift tax exclusion planning are available to families with a fraction of that net worth, and most never use them, simply because nobody explained they existed. Lesson 3. The rules change, and they change on political timelines, not personal ones. The permanent $15 million exemption feels settled today. It wasn't settled 18 months ago, and GRATs have faced repeated legislative attacks. For over a decade, anyone with meaningful assets should treat today's rules as a snapshot, not a guarantee. The families who benefit most from this system aren't necessarily the ones with the most money. They're the ones who found out these tools existed early enough to use them. That gap between what's legally available and what most people have ever been told is the real hidden tax code. If this changed how you think about wealth and taxes, subscribe to the Wealth Compass. We decode the systems nobody explains to you. One question before you go: should tools like GRATs be closed by law, or is this just smart planning anyone should be allowed to use? Tell us below. This was the Wealth Compass.